Hello, everybody. Sorry about that brief delay. We had a little bit of a technical glitch, but we are so glad that you are all joining us today here. Simplicity Des Moines. I am Sarah Albrecht, the Director of Media Marketing, and hopefully still somebody who will be working with IT after this is over. But I have got Elena Castor on the line from AIN, and she's got a wonderful presentation for us. We're going to take just a minute, give everybody a chance to get signed in, and I'm going to go ahead and sign off now and sign it over to Elena, who will be presenting with us. Again, asset-based, pardon me, long-term care. It is amazing program. And we have Al Stockwell here. He is our Life Marketing Director who will be facilitating the Q&A. So please feel free to raise your hand or submit a Q&A question. Looks like most people are getting signed on. So I'm going to go ahead and turn it over to Elena. Please take it away.
All right, thank you so much, Sarah. I appreciate the introduction. As Sarah mentioned, I'm with the Advantage Insurance Network, and we have over 150 member firms that we work with across the country. So on a day-to-day, I do work with advisors in the asset-based long-term care arena. So today, that will be our topic. We're going to talk about the landscape, what that looks like, and more importantly, what's selling now. So I'm going to be covering some key successful strategies that are working across the country. And so you'll have some great takeaways today. Before we get started, I am also going to be covering just some nuances of what we saw in the industry, say, since the pandemic started. So I'll go ahead and just dive right in here. Just want to make sure everyone is seeing the appropriate screen. Sarah, you just seen my one screen, the asset base, the title screen.
Lennon, I'm not seeing your screen on the.
Yeah, I'm not either.
All right, hold on one second, everyone. I'm going to do this again.
There you go.
All right, can you see it now?
Yep, you're all set.
Awesome, thanks.
That's good.
Little glitch there in the Zoom. All right, so I want to get started here. Before we dive into sales strategies, everyone, I'd like to kind of introduce you to some of the key players in this marketplace. And we're going to start with this list here. Keep in mind, it's not all inclusive, but these are the top 5 carriers that come into play on a day-to-day for me when I am doing case design. So we've got both the asset-based long-term care plan as well as the asset-based long-term care annuity. So Global Atlantic has the 4-care annuity product. Lincoln with their MoneyGuard 3. They also have rolled out a new product this year on a securities chassis, very different, but exciting for them with that product. It's the first of its kind. Nationwide with Care Matters 2, One America with their asset care, as well as an annuity care plan, and Securian with their secure care product. So just know that between these players, they all have something very niche that they bring to the table. And that helps me tremendously, and advisors understanding some of those nuances between these carriers and what they offer. And to give you a quick example, Lincoln MoneyGuard, true 0-day elimination period. So when we're talking with clients about how these policies perform, we know that at claim time, there's no surprises with a deductible. Nationwide Care Matters, they've got a nice feature I'll be talking about in a little bit here that is definitely unique. One America Asset Care and Annuity Care, they are well known and very successful at what we call the joint policy design for couples. And they have also a very nice qualified strategy, which I'll also be touching on a little bit later. And Securian with Secure Care, they have 100% built-in ROP feature on their product. So those are just some examples of the niches that they bring to the table. The annuity definitely has its place in the market as well. And we pivot to those when, to give you a good example, maybe somebody is 70, we might be able to get more benefits or more leverage, if you will, by looking at the asset-based long-term care annuity in certain situations. So keep that in mind. Now, let's dive right into some of the nuances that we've seen. COVID brought about a ton of changes for everyone, good, bad, everything above. But what we saw happen, immediately when it started to happen, we saw insurance companies pulling back, if you will. And what I mean by that is the issue ages that you can see on the screen were, they were shaved. Nobody wanted to see an application, between 30 and 40. And since then, some of the carriers have come back and now they've opened up the issue ages again. They also cut issue ages at 69 and up. So we saw that happen in the first year. But again, we're getting back to that normal issue age that we're used to. So I wanted to just state those up here. As you can see, the younger issue age is 35 with One America. Lincoln Money Guard didn't quite come back yet to that younger age group. They may not. They've been holding there for some time, but we'll see. And also, elephant in the room here, the Washington tax mandate, that definitely impacted the insurance companies more so than they had anticipated. And what I mean by that is, this mandate brought about kind of a surge of people scrambling for an opt-out because they didn't want to have to pay the tax. So because of that, certain companies were offering, their policies with no limitations. We saw some limitations. And eventually, as we got near the November 1 deadline for folks to opt out in Washington, we saw carriers, they were issuing submission deadlines and not making promises that they can deliver. And so that, with a couple of our companies, they're still flushing out some of that business. So we don't have Washington open in every state, particularly with Nationwide and One America, as you can see on this list. So Lincoln just opened up the doors for Washington business 2 weeks ago. Global Atlantic, being that they have a niche or a specific design of a single premium, they never really cut the spigot for Washington cases because they didn't see a bulk of those cases. The majority of the cases for opt-outs went to the other carriers that were not annuity sales. So those are some of the nuances we saw the past year and a half. So keep that in mind. Hopefully the Washington tax mandate, will evolve to something final, but as it stands today, a couple of weeks ago, legislators went back into sessions and they came back out with 2 bills. The intention of going into those sessions for January was to clean up some of the language so that certain folks, maybe it's military, people who live in the border states who work in Washington and would have to pay the tax and not ever see a dollar of those benefits. They were supposed to clean up some of that so that it was a more fair type of plan in who would be paying that tax. Instead, we got 2 whole new bills, Republicans proposing to put a kibosh on the tax altogether, and the Dems pushing for a delay in that tax until 2023. So currently that's where we're at. Insurance companies are keeping their ear to the ground, if you will, and paying attention as other states are looking at this mandate. So all I can say here is stay tuned. It seems to be evolving, with changes, and we'll see more in the near future, I'm sure. So I'm going to move on here. I want to talk about one of the shifts that we're seeing here in this product segment. One of the things I really love about these products is that, they have guarantees around all the benefits. But with that, because of this low interest rate environment that we've been in for so long, we're starting to see that shift. And one of those is by Nationwide. And we're going to get into a little case study here to go over this. So currently on an asset-based plan, the typical design might be a 6-year benefit, as you can see here, maybe a single premium. This is a female 60. And usually the options are 3% or 5% inflation options. And those get locked in, they're guaranteed. This case study is just showing a new feature that's rolled out by Nationwide on their Care Matters 2 product. It's called the Medical Inflation Index. So they're not replacing, just so I'm clear, the compounding inflation options. It's just an additional option that clients have that they can choose in these products as an alternative to that guaranteed option. So we're going to talk about this for a couple of minutes here, and we're going to focus on how this can better position the client when they get to claim time. In this case, we're looking at age 80 values. So if this particular client chooses to go, that common route of 3%, she will have over $568,000 in her long-term care pool by the time she goes on claim. And that's going to equate to a monthly benefit of $7,324. Now, that's pretty good leverage, right? She's got over 5 times leverage of her single premium. But now let's say she considers this index. What does that look like and how does it work? Well, imagine, if you will, an index UL illustration for any of you life advisors out there. This kind of resembles the index UL illustration, right? You've got that minimum 0% floor on the IUL with a midpoint rate of return and a high point. Same here, only with the medical inflation index, it's following the consumer price index. So this isn't something that as an advisor, you might have to do, intense research to understand it. Nationwide does a really good job of including this index and a full historical built into the illustration, so you can kind of see how this performs over the long period of time. So if she considers this, let's say the medical inflation index just keeps going down every year, Nationwide will credit the client's account 2% as the floor, guaranteed every 2 years. So they're going to true up the client's account. And when we're looking at this in terms of risk, we're looking at a difference of 3% to 2%. So yes, there's a 1% risk to the client, but just as you would talk about an index universal life plan and how they perform, we know that the client is likely going to end up in this range, right? So now we're talking over $600,000 in her total pool, or a monthly benefit for long-term care expenses of over $7,500 a month. And if we jump to that high end, we're approaching $12,000 a month for her long-term care benefit, and well over $1 million in her total pool. Now that's a significant and powerful story to be sharing with clients and allowing them that additional option versus the 3% guarantee. So what I really like about this offer with Nationwide is that regardless of which option your clients decide to go, that 3% inflation, or maybe take a little risk and go into the medical inflation index option, their death benefit in these plans is not going to change. That guaranteed cash value is not going to change. It's going to be the same no matter which option they go. So one of the things I've seen throughout the pandemic is a younger age demographic, if you will. So late 40s, all through the 50s, inquiring about long-term care, because that's what the pandemic has done. It's heightened the awareness about the thoughts about getting sick. So with that, imagine if this client here was 50, she'd have another 10 years to take advantage of that potential growth. So again, a more powerful opportunity here to get significant benefits for a client's long-term care plan when they go to claim. Before I move on here, there is another shift we're seeing, and this, I mentioned this a few minutes ago. Lincoln rolled out a new asset-based plan. It's on a securities chassis, very different because of that, not fully guaranteed, but just know it's getting traction in the marketplace. It's very competitive. So if this piques your interest at all, just circle back with the team over at Simplicity, talk to Al or myself, and we can get you on the right track to get some more information on that new plan. All right, so let's shift gears here. I want to talk about something else that we've seen, and this is really a different shift or trend, if you will, even pre-pandemic. And I think this is going to be around for a long time, but we're seeing a liking for life pay premiums. And who does that, who can you market to with a life pay premium, and who would be attracted to this? That target market actually is fairly broad when we start to break it down. So when we talk to young professionals, these are folks that can't, they don't have assets to reposition like a single pay. A 10 pay policy and a 20 pay is usually kind of not affordable for them as well. So with that, we found that the younger demographic is professional, if you will, is definitely open to paying ongoing premiums And those premiums can really range, say, from 3,000, maybe up to 7,000, and they're okay paying those year after year. Now, middle market, similar to the young professional, they're still accumulating those retirement assets, so there's no repositioning of an asset for them usually, and they're not comfortable with a 10 pay and sometimes even a 20 pay. So that market, to me, sometimes overlooked, but definitely open to paying ongoing premiums. Now, these next two, the savvy investor and the financial advisor, I couple them together because they kind of go hand in hand. And we've been able to position these a little bit differently when we're working, say, with a wealth management advisor. Now, if I was to position, say, a 6-year plan that I just showed you a few minutes ago with 3% compounding to the savvy investor who might be earning anywhere from 8 to 13% on one of their higher earning assets in their portfolio, this proposal would not raise an eyebrow for them. They don't get very excited about that. What we've been able to do is take a look at one of those higher earning assets in their portfolio and take distributions on that, or a slow drain, if you will. Every year you take that distribution, that pays for the long-term care plan, and you accomplish two things that makes a win-win here for both the investor, for the client, and for the advisor. And that is, you're not asking the client to reposition any assets. You're not asking them to surrender or to pull from a cash position. And you're not asking the wealth management advisor to take assets off the books. That's how they get paid, right? They're getting paid to acquire and keep assets under management on the books, if you will, not by letting those assets go. So it does create a win-win scenario for the client and the advisor. And there's also an opportunity for trailer commissions here, depending on the type of sale and the carrier that we go with for this particular case. So keep that in mind when you're thinking about life premiums. We have a couple of carriers who do offer the life pay premiums, and this is an actual case study I want to share with you. This is a male 50. He came to us through the advisor, was already dealing with a claim, if you will. His mother-in-law was suffering from dementia. So wanted to do some planning for him and the wife actually already had something in play. So we only needed to plan for him. And take a look at his age. He's 50. He's representing that younger demographic. Well, his budget was $5,000. So we had $5,000 to work with for an ongoing premium. That opened the door to be able to position Nationwide's Care Matters 2 product and also One America's Asset Care product. Now, Asset Care has that niche design, unlimited benefits forever, right? That policy stays with you for your lifetime. We assumed after talking to the advisor that this client would be attracted to that after having experienced, X amount of years already dealing with the mother-in-law having dementia. So this client had a good feel of cost, the burden that it was causing and the pressure and, all the emotions that go with that when you're taking care of a loved one. This couple also had kids in the home. And I think that was one of the driving points is they wanted to plan for themselves so that they didn't put their children in this position to have to do what they were doing with the mother-in-law. So with that, we positioned both plans. And as you can see, the larger monthly benefit was $10,923 by this client's age 80. He had well over $800,000 in his total pool. And he really liked that larger benefit over the trade-off of that $8,839 monthly benefit with One America's Asset Care. And of course, understanding, and I'm sure the advisor had explained this, but when you're looking at average claims, say 2 to 4 years, I think that's important for clients to understand, that their claim on average will go that long, with some of those outlier claims going much longer, especially with cognitive illness like this client's mother-in-law. So, we were wrong in assuming he would like the unlimited plan. He chose the Care Matters 2 plan, but it wasn't, an easy sale. One of the concerns the client brought up was that over 30 years, he would have paid $150,000 into this plan. So when you put that total outlay in perspective, that's a lot of money for a client with a $5,000 budget. However, we went back and revised the illustration to make sure we included the internal rate of return. And the internal rate of return for this particular client was over 8.5%. So after another discussion, second meeting, the advisor was able to overcome that's what I call small objection, if you will. And this case was sold and is on the books today. So a win-win for both the client, who felt that he was maximizing his options and benefits going with the nationwide plan over the One America plan. So that's the appeal of LifePay. And now I want to switch gears again here, and we're going to talk about a different sales strategy altogether. This incorporates taking advantage of the language from the Pension Protection Act. So within the act, and it's been around a long time, that law went into play in 2010 when it was enforced. And because of the language in the Protection Act, we can now take advantage of that and create a powerful strategy for clients, particularly those with non-qualified annuities. And that's what this example is going to go into. But I want to start with talking about the opportunity. So recent studies showed 73% of annuity policy owners had earmarked their annuity for an emergency fund, catastrophic illness or nursing home care, if you will. So think about that number for a second. 73%. They didn't say, I'm going to use my annuity as intended and planned for with my advisor for supplemental retirement income. They didn't say that. They've already earmarked it for care. And we know that there's trillions of dollars in the annuity market, right? That's on the books. Knowing that the 73% have answered this survey this way, I think this is somewhat of an untapped opportunity. We are seeing success with it, but I think there's definitely more opportunity here for more sales with the non-qualified annuity. So let's take one of those clients and let's take an example that they are going to use their annuity as planned for that emergency fund. And here's what that looks like. This client's in a 24% tax bracket. They've got a cost basis when they started their annuity of $150,000. Roll forward today, several years later, this client now has $200,000 in the annuity. So we've got a $50,000 gain in that contract. Roll forward, client has an event and needs to now use the annuity as planned to pay for their care. Because of that gain, they're actually going to net after taxes $188,000 of their $200,000 annuity. So not a bad plan, right? The fact that the client had already earmarked this tells you, they've already made a plan for long-term care, right? How can you as an advisor come in and improve this position? We can do that because the Pension Protection Act allows for the client to 1035 exchange that $200,000 annuity over into a qualified long-term care plan. In this particular example, we're looking at Global Atlantic's 4Care plan. So immediately from day one, they make the 1035 exchange and they leverage up the client's account 3 times their value. So now we're talking $600,000 of income tax-free long-term care benefits that the client can use when they go to claim. Regardless of that gain in the contract, as long as they use it for care, they're not going to pay taxes on that $50,000. If they were to disrupt the contract before a claim, then it's just going to be treated like an annuity, right? Possible tax and penalty. So very powerful strategy here. They leverage up 3 times. We even have an inflation option on that product. So that $600,000 can still grow significantly down the road using that option. So that is the Pension Protection Act strategy that we're seeing being used. I'm going to pivot now here to a qualified funding strategy. So completely different strategy, obviously working with qualified funds. We have 2 strategies of how we handle this here. One of the common, what I call a one and done solution that we've seen a lot of success is with One America. And let's assume this 67-year-old male client has a $200,000 account value in his IRA and he's considering taking it over into One America's asset care plan. What happens with that qualified transfer? It comes over to One America. They take that and deposit that into their deferred annuity, not an immediate, but a deferred annuity with an income rider. They also bonus that $200,000 by 10%. That's how we get this $220,000 IRA annuity value from day one. They then internally, so this is seamless to the client, make distributions over 10 years. Because this is qualified money, can we escape the tax? No, cannot escape the tax. So every year client will get a 1099 and stretch out those taxes over 10 years in the amount of $22,000 for the 1099. Now those payments are going into the asset-based plan, purchases immediately $221,283 of the life insurance component, and a total long-term care pool of $663,849. Again, great leverage here by repositioning that asset over into this strategy with One America. And that client's monthly benefit would be $8,851 per month over a 75-month period. Now, one thing I'm not showing here on the screen, there's an additional feature here that clients can take advantage. They can add a spouse onto this plan. So that also has played very well in positioning the qualified strategy with One America with this one and done solution, if you will. It looks a little complicated, but just know all the processing is done behind the scenes. Clients will receive their policy and a 1099 over a 10-year period. So that's the qualified strategy. If you have any questions on it, we can circle back to this a little bit later. I'm going to move on here. My space bar will let me. There we go. And I want to shift gears here. I want to talk about flexible benefits. This is another shift we're seeing in how insurance companies are paying long-term care benefits at claim time. So what I mean by that is traditionally, we have a reimbursement model type plan, which pays for actual expenses as they're incurred and the clients get reimbursed. Any unused monthly benefit just stays in the client's account or in their policy, if you will, to be used for future claims. The indemnity model pays that full monthly benefit regardless of what the client's long-term care expenses are. Two very different models, right? But what we're seeing is a shift here. Lincoln came out with a feature called Flex Care Cash. With the Flex Care Cash benefit, it's truly what I call an indemnity feature. The way this works is, let's assume this client goes on claim. They've got a $9,000 monthly benefit at claim time. They're getting care in the home per the doctor's approval and written plan of care. The client gets out of the hospital, goes into the home, and has a nurse coming out to the home, say 2 days a week, checking vitals, medications, so forth. All the other days a week when the nurse is not coming to the home, this is when the client can ask a neighbor, a friend, maybe it's a spouse helping or son or daughter, to help out with those day-to-day duties that the client can't do. Maybe it's meal prep, maybe it's gardening, checking the mail, house chores, etc. It's truly a cash indemnity feature that gives more flexibility for the client on this reimbursement plan to access their benefit. Now, keep in mind, they can get up to 1/3 of their monthly benefit. So with this $9,000 a month, let's assume $6,000 are their nurse, is the amount of the total monthly expense with the nurse coming out to the home. That balance leaves $3,000 / 1/3 of their monthly benefit available for this indemnity cash payout. So it's a wonderful feature they've added. Again, I think it just shows that the carriers are trying to be more flexible on these reimbursement models to get the clients their benefits. So that's the Flex Care Cash feature. I'm going to wrap it up here. One other final note I'd like to close with here is that if you're not working in this space with asset-based long-term care plans, It's an exciting space. It's always evolving, which I like. Lots of changes that come about, product enhancements. And of course, with that, sometimes we see pricing changes as well. But just know, this whole line of business can be automated, if you will. It doesn't represent 100%, of most of our member firms' business line. We have a handful of agencies who do focus in this area. That's all they do, but the majority do not. It might be 5, 10, or 15% of somebody's, book of business and product offering to their clients. But just know it is being more automated, more so than ever. And that's, to me, an advantage. We've seen cases get wrapped up in a matter of days, from application submission to policy issue. Typical, call it 2 weeks, but these policies only require simplified underwriting. So no parameds, no blood work. E-processing is the way to go. We've got 2 carriers now on board that handle like 100% of the underwriting electronically. And that's where you can get a case in and out in a matter of days. So keep that in mind if you're not working in this space. Would love to work with you on a case, and hopefully this has maybe brought some clients to mind for you after covering and touching on the various strategies we covered today. So I'm going to handle the controls. Back over to you, Sarah and Al, for any questions.
All right, thanks, Elena. Appreciate it. Really good stuff as always. Did get a couple of questions here. Let me. There's a question about the 1035. The annuity must be out of surrender, correct?
Must be out of surrender. I don't think it has to be out of surrender, but I will double check that.
I'm agree with you. I don't think it has to be out of surrender, period. But I guess that's maybe a good question then.
Yeah, it's always good to double check.
Yeah.
I'm going to write that one down. Okay, next question.
There was a question about on the nationwide, when you're talking about that medical, the new feature with nationwide.
Index.
Yeah, they asked what the CPI index, what CPI index is used. Do you know off that top of your head? That's
no. So it's basically they take the medical inflation index, which is part of the overall CPI as it relates to the medical care cost. So it's pulled out of that number. What I can do is send you an example of the historical showing you how this is performed. There's more details on it built into the illustration.
yeah.
It may go into the detail that you need. If it doesn't, we'll get you that answer.
Great. Perfect. I think that was most of the questions. So unless everybody has anything else, thank you again, Elena, for doing this great presentation. We always appreciate it. It's always good information. So I'm sure there'll be a lot of questions. So if you have any cases you would like to see us run or any questions, product specific, anything like that, just give us a shout here, either at the office at 800-747-5612, or my email address is right there on the screen, al.stockwell@simplicitygroup.com.
All right.
Thank
Thanks,
you.
everyone. I appreciate your time today.
Thanks a lot.
Bye.
Bye-bye.